There is a single silent assassin that stalks the financial landscape, responsible for more permanent catastrophic losses of capital than any market crash, any recession, any war. It doesn't announce its arrival with the ringing of a bell on the New York Stock Exchange floor. It doesn't appear in the headlines until it's far too late. This killer hides in plain sight, on the financial statements of thousands of publicly traded companies, often masquerading as a friend, a tool for growth, a symbol of ambition. It is corporate debt. And for over 70 years, one man has treated it not as a tool, but as a ticking time bomb strapped to the hull of an otherwise seaworthy ship. That man is Warren Buffett. And his profound, almost pathological aversion to leverage is not just a quaint preference. It is the central pillar of a philosophy that has compounded capital at a rate that defies financial gravity. It is the secret to building a portfolio that doesn't just survive downturns, but feasts on them. We are taught to admire growth. We celebrate the company that expands across the country, the tech firm that acquires its smaller rival, the CEO who makes bold, leveraged bets to conquer a market. This is the story we are sold. But it is a dangerous and incomplete story, because for every tale of leveraged triumph, there are 1,000 silent deaths. Companies that looked invincible in the sunshine of a bull market, only to find their foundations washed away by the first rains of a recession. Their debt, the very engine of their celebrated growth, became the anchor that dragged them to the bottom of the ocean, taking 100% of their shareholders' capital with them. What you are about to learn is not a stock tip. It is a fundamental shift in perspective, a new lens through which to view every investment decision you will ever make. This is the principle of the fortress balance sheet. It is the understanding that the first job of an investor is not to make money, but to ensure you never lose it in a way that prevents you from playing the game tomorrow. By the end of this journey, you will no longer look at a company's soaring revenues and feel excitement. You will first look at its balance sheet and feel for stability. You will learn how to distinguish financial strength from financial engineering, how to spot the hidden fragility that lies beneath a glossy corporate narrative. This is the difference between amateur speculation and professional capital allocation. It is the key to sleeping soundly at night, knowing that your financial future is not built on a house of cards, but on a bedrock of unshakable financial strength. This is the final promise that separates the investor from the gambler, the promise of survival, the promise of endurance, and the promise of ultimate victory. The year is 1931. The dust of the great crash of 1929 has not settled. It has billowed into a suffocating cloud that hangs over the entire American economy. In Omaha, Nebraska, a young man named Howard Buffett goes to work every day as a stock salesman at a small local bank. He is a diligent, honest man, trying to build a life for his family, including his infant son Warren. But the world around him is disintegrating. The optimism of the roaring 20s has curdled into a bitter, pervasive fear. One day, the whispers start. A rumor, a tremor of panic, that the bank is unsound. In the Depression-era economy, such a rumor is a death sentence. A line begins to form outside the bank's doors. Then it becomes a crowd. Then, a mob. People who had entrusted their entire life savings, the fruits of years of labor, are now pounding on the doors, their faces etched with desperation, demanding their money back. Howard Buffett stands inside, watching the lifeblood of his community drain away. He watches as the bank, unable to meet the demands of the run, closes its doors for good. He is not just an employee who has lost his job. He is a man who has witnessed the social contract tear apart at the seams. His family's savings, like those of his neighbors, are gone. He is forced to start over from nothing, founding his own small investment firm in the rubble of the financial system. For young Warren Buffett, growing up in the shadow of this event, the lesson was not an academic one learned from a textbook. It was visceral. It was the quiet anxiety in his father's voice, the frugal reality of their household, the ever-present ghost of that closed bank door. He saw firsthand that you could be smart, you could work hard, you could do everything right, but if the institution you were tied to was built on a fragile foundation of leverage, of promises that couldn't be kept in a storm, it would all be washed away. Debt, he learned, was a promise made in the sunshine that had to be paid in the rain. When the rain came, and it always comes, those who were over-leveraged were not merely inconvenienced, they were annihilated. This single formative trauma became the genetic code of his investment philosophy. It was the foundational fear that would guide every major decision for the next 80 years. Avoid, at all costs, the kind of fragility that can lead to a 100% wipeout. Before seeking gains, one must first ensure survival. This was not a strategy for wealth management. It was a commandment for capital preservation. This deep-seated fear of ruin is rooted in one of the most powerful psychological principles known to man: loss aversion. Decades of research by behavioral scientists like Daniel Kahneman and Amos Tversky have demonstrated a simple, profound truth about the human brain. The pain of losing is psychologically about twice as powerful as the pleasure of an equivalent gain. If you find a $100 bill on the street, you feel a pleasant jolt of happiness. If you lose a $100 bill that was already yours, the negative feeling of that loss is dramatically more intense. Our brains are hardwired for survival, not for abstract portfolio optimization. We are programmed to react far more strongly to threats than to opportunities. Warren Buffett's genius lies in his ability to harness this cognitive bias, which cripples most investors, and turn it into his greatest strength. While the average market participant is chasing the pleasure of a 20% gain, Buffett's mind is ruthlessly focused on avoiding the pain of a 50% loss. He understands that the math of loss is unforgiving. If you lose 50% of your capital, you need to make a 100% return just to get back to even. The game becomes exponentially harder. Therefore, the most important rule of investing, as he famously says, is rule number 1: never lose money. Rule number 2: never forget rule number 1. This isn't about avoiding any and all risk. It's about distinguishing between manageable risk and what he calls the risk of ruin. A stock price going down is a manageable risk. You can hold on, you can buy more if the underlying business is sound. A company going bankrupt because it can't service its debt is the risk of ruin. It is a permanent, irreversible loss of capital. By letting the intense, primal fear of loss, a fear instilled in him by the ghost of his father's failed bank, guide his decision-making process, Buffett structurally insulates himself from the single greatest cause of permanent capital loss. He is not trying to beat the market every year. He is trying to ensure that he is never, ever forced out of the market. This intense focus on capital preservation, born from loss aversion, is what allows him to think in decades when others are thinking in quarters. He is playing a different game, a longer game, a game where survival is the prerequisite for victory. So how does this translate from a psychological principle into a practical, applicable mental model? It becomes the sleep at night test, a simple yet profoundly effective filter for any potential investment. This isn't a complex spreadsheet model, it's a qualitative gut check rooted in the worst-case scenario. When you are analyzing a business, before you look at the price-to-earnings ratio or the growth projections, you must perform this test. Step 1 is to ask a brutal question. If the global credit markets froze solid tomorrow, if banks stopped lending to everyone, and if the economy plunged into a severe 3-year recession, could this company survive using only the resources it has on hand right now? This is not a hypothetical exercise. It happened in 2008. It has happened countless times throughout history. You must assume it will happen again. Step 2 is to find the evidence. You open the company's latest financial report and look at 2 numbers: cash and marketable securities on one side, and short-term debt due within 1 year, on the other. Is there enough cash to cover that immediate debt with a wide margin to spare? What about their ongoing operational costs? Could their cash flow from operations, even in a recessionary environment, cover their interest payments many times over? Step 3 is the final: personal commitment. Imagine you don't just own a few shares of this company. Imagine you have inherited it. It is your family's entire net worth. You own 100% of the business. Now, knowing its debt load, would you be able to sleep soundly at night? Or would you be tossing and turning, worried that a single bad quarter or a tightening of credit from the bank could put your entire livelihood at risk? If the thought of personally guaranteeing that company's debt gives you even a flicker of anxiety, you walk away. No potential upside is worth that kind of fundamental fragility. This test reframes the investment decision from one of a retail investor looking for a quick gain to one of a prudent business owner focused on long-term survival and capital preservation. It's the simplest, most powerful risk management tool in your arsenal. Now let's explore the antithesis, the path walked by the 99% of investors who fall prey to the allure of debt. This is the path of growth at any cost. In the throes of a bull market, when money is cheap and optimism is high, debt is seen as free fuel. The market rewards companies for aggressive expansion. A retail chain borrows heavily to open 100 new stores. A software company issues billions in bonds to acquire a competitor. A manufacturer leverages its balance sheet to buy back its own stock, juicing the earnings per share metric. The stock prices of these companies soar. The CEOs are hailed as visionaries on the covers of business magazines. The analysts who recommend these stocks look like geniuses. Investors who pile in feel a sense of euphoria, their account balances climbing week after week. They are not looking at the balance sheet, they are looking at the stock chart and the growth story. They have mistaken financial engineering for operational brilliance. Consider the archetype of a trendy consumer products company. It has a hot new product, and demand is exploding. To meet this demand and seize market share, the management team decides to go all in. They take on massive amounts of debt to build new factories, to launch a global advertising campaign, and to rapidly scale their workforce. For a time, it works spectacularly. Revenues are doubling year over year. But underneath the surface, a cancer is growing. The interest payments on their debt are a huge fixed cost. The new factories are a massive drain on capital. They are walking a tightrope. As long as the economy is strong and consumer spending is high, they can just about manage. But then the inevitable happens. A recession hits. Consumer confidence plummets. Sales of their non-essential product drop by 30%. Suddenly, their revenue is no longer sufficient to cover their operating costs and their massive interest payments. They start burning through cash. They go to the banks for more credit, but the banks, now fearful, say no. Panic sets in. They announce layoffs. They try to sell assets. But it's too late. The debt covenants are breached. The creditors take control. The company files for bankruptcy. The stock, which was once the darling of the market, goes to zero. Every single dollar invested by its shareholders is gone, forever. This isn't a rare occurrence. It is the predictable, tragic end for thousands of companies who choose growth over stability. They have made a deal with the devil, trading resilience for a short-term burst of speed, and when the bill comes due, it costs them everything. The direct financial connection of Buffett's philosophy is the concept of avoiding permanent capital loss. On a financial statement, this distinction is stark. Imagine two companies, Company A and Company B, both hit by the same severe recession. Their stock prices both fall by 50%. For the investor, this feels identical, a painful paper loss, but their fates could not be more different. Company A has a fortress balance sheet, very little debt, a huge pile of cash. Their profits decline, but they can easily cover their minimal interest payments. They weather the storm. When the economy recovers, their business rebounds, and the stock price eventually follows suit. The 50% loss was temporary. Company B, however, is highly leveraged. The drop in profits means they can no longer make their interest payments. They breach their debt covenants. The company is forced into bankruptcy. The stock is delisted and becomes worthless. The investor's 50% paper loss has just crystallized into a 100% permanent loss. There is no coming back from zero. The debt on the balance sheet acted as a chemical accelerant, turning a cyclical downturn into a corporate extinction event. A fortress balance sheet, therefore, is not a tool for maximizing returns in any given year. It is an insurance policy. It is an all-peril insurance policy against the single most destructive event in an investor's life, the permanent and total loss of capital. By making the avoidance of this outcome your primary goal, you fundamentally change the probability of your long-term success in the world of wealth management and building wealth. You ensure that you will always be around to fight another day. It was the autumn of 1998, and the global financial system was staring into the abyss. The culprit was a secretive, high-flying hedge fund called Long-Term Capital Management, or LTCM. But this was no ordinary hedge fund. Its partners were a dream team of financial superstars, including two Nobel Prize-winning economists, Myron Scholes and Robert Merton, men whose mathematical models for pricing derivatives were the gospel on Wall Street. They were, by any objective measure, the smartest guys in the room, and they were making money at a breathtaking pace, delivering returns of over 40% annually. Their strategy was complex, involving thousands of trades designed to exploit tiny, fleeting discrepancies in bond prices around the world. Each individual trade was extremely low risk. But to make meaningful profits from these tiny discrepancies, they employed a terrifying amount of leverage. For every $1 of their own capital, they had borrowed and were trading with more than $25. Their balance sheet was a skyscraper built on a pinhead. For a few years their genius seemed undeniable. They were the kings of the financial universe. But then, in August 1998, Russia defaulted on its domestic debt, a black swan event that their models had deemed virtually impossible. The carefully constructed web of their trades began to unravel. The small, low-risk positions all started losing money at the same time, and the losses were magnified by their extreme leverage. The fund began to hemorrhage billions of dollars a day. A panic ensued as the world's largest banks, who had lent LTCM hundreds of billions of dollars, realized their client was on the verge of a catastrophic collapse that could trigger a chain reaction and bring down the entire global financial system. In a desperate attempt to stave off disaster, the Federal Reserve Bank of New York summoned the heads of Wall Street's biggest firms to a boardroom, and they also placed a call to one man in Omaha, Nebraska, Warren Buffett. They offered him a chance to lead a bailout consortium to take over and unwind LTCM's toxic portfolio. Buffett reviewed the situation and ultimately declined to participate in the Fed's plan, but the lesson of LTCM became a cornerstone of his teachings on the dangers of leverage. He later summarized it with a devastatingly simple quote: "To make money they didn't have and didn't need, they risked what they did have and did need. That is foolish. It is just plain foolish." The smartest men in the world, armed with Nobel-winning theories, were brought to their knees because they made a devil's bargain with leverage. They were seduced by its power to amplify gains, and in doing so they ignored its equal and opposite power to amplify losses to the point of total annihilation. The psychological trap that ensnared the geniuses at LTCM is a potent combination of the overconfidence bias and the Dunning-Kruger effect. Overconfidence bias is the well-documented tendency for people to have excessive faith in their own knowledge and abilities. The more successful you are, the more susceptible you become. The partners at LTCM weren't just successful, they were legends. They had won Nobel Prizes. They truly believed their mathematical models had tamed risk. They thought they were smarter than the market, smarter than history itself. This is compounded by the Dunning-Kruger effect, a cognitive bias where people with low ability at a task overestimate their ability, but it also has a corollary for experts. Highly competent individuals can become so specialized that they fail to recognize the limits of their own knowledge. The LTCM partners knew their models inside and out, but they were blind to the messy, unpredictable, and often irrational nature of the real world, a world where freak events like a Russian debt default could happen. Leverage acts as a powerful accelerant to this overconfidence. When you are leveraged, even small successes are magnified into huge wins, reinforcing the belief that you are a genius. An investor who makes a 15% return feels smart. An investor who uses leverage to turn that same 15% asset return into a 50% equity return feels invincible. They begin to attribute their success purely to their own skill, rather than to the high-risk strategy they are employing. They take on more and more leverage, each successful bet emboldening them further, until they are so far out on a limb that a single unexpected gust of wind is enough to send them crashing to the ground. They forget that the market has a way of humbling even the most confident of geniuses. To protect yourself from this siren song of leverage, you need an analytical mental model that cuts through the illusion. This is the leverage magnifier visualization, a technique that uses a simple financial formula called the DuPont analysis. When you look at a company, one of the most common metrics of performance is return on equity, or ROE. It tells you how much profit the company generates for every dollar of shareholder equity. A company with a high ROE, say 25%, looks incredibly attractive. But the leverage magnifier model forces you to ask, where is that return coming from? The DuPont formula breaks ROE down into 3 core components. Step 1. Find the company's net profit margin. This measures its operational efficiency, how much profit it makes per dollar of sales. Step 2. Find its asset turnover. This measures how effectively the company is using its assets to generate sales. Step 3. Find its equity multiplier, which is simply total assets divided by shareholder equity. This third component is a direct measure of financial leverage. The higher the number, the more debt the company is using to finance its assets. Now, you have the blueprint. When you see a company with a high ROE, you perform the visualization. Imagine 3 separate dials. Is the ROE high because the profit margin dial is cranked up? That's fantastic. It means the company has a great product or a strong brand with pricing power. Is it high because the asset turnover dial is cranked up? Also great. It means the company is a lean, efficient operator. But if you see that the first 2 dials are mediocre, and the high ROE is almost entirely due to the equity multiplier dial being cranked up to a dangerously high level, a warning bell should go off in your head. You can now see with crystal clarity that this company's impressive performance is not the result of business excellence, but of financial engineering. It is a sugar high, fueled by debt. This mental model allows you to pierce the veil of a single, misleading headline number and understand the true quality and sustainability of a company's earnings. It's a crucial tool for any stock analysis that aims to go beyond the surface and assess true risk. The antithesis to this careful analysis is the all-too-common behavior of chasing high flyers in a bull market. The average retail investor, bombarded with exciting stories of explosive growth, often becomes a participant in a grand popularity contest, not an exercise in business analysis. They see a company whose stock has doubled in the past year and feel the powerful grip of FOMO, the fear of missing out. They hear a compelling narrative from the CEO about disrupting an industry or changing the world. They see that other people are getting rich and they want in on the action. What they don't do is spend 10 minutes reading the balance sheet. Let's take the classic example of a rapidly expanding restaurant chain. They are opening new locations at a frantic pace, and revenue growth is off the charts. The stock is a darling of Wall Street. Investors who bought in early have made a fortune. New investors pile in, chasing the momentum. But how is this expansion being funded? Almost entirely with debt. They are leasing expensive real estate, taking out loans for kitchen equipment, and issuing bonds to fund their marketing blitz. The balance sheet is groaning under the weight of these liabilities. But as long as the economy is booming and customers are lining up, the cash flow is just enough to keep the plate spinning. Then, a mild recession hits. People eat out less. Same-store sales, the key metric for any retailer or restaurant, begin to decline. The once mighty growth story screeches to a halt. But the rent is still due. The interest payments to the bank are not negotiable. The company's profits evaporate and turn into losses. They try to cut costs, but it's not enough. They are now in a death spiral. To raise cash, they might try to issue new stock, but with the share price plummeting, this would be massively dilutive to existing shareholders. Eventually, they default on a loan. The house of cards collapses. The stock that everyone was chasing is now worthless. The investors who were seduced by the top-line growth story and ignored the underlying financial structure are completely wiped out. This story has played out time and time again, with companies from retail to energy to technology. The pattern is always the same. Leverage-fueled growth creates a temporary illusion of genius which inevitably shatters at the first sign of economic adversity. The direct financial connection here is the brutal and unforgiving asymmetry of risk that leverage creates. For a corporation, debt introduces a dangerous rigidity into a dynamic world. A company's revenues are variable. They go up and down with the economy. Its operating costs can often be adjusted. You can slow down hiring or cut marketing spend, but interest payments on debt are a fixed, non-negotiable cost. They are a promise that must be kept, in good times and in bad. This fixed cost acts like a guillotine hanging over the company. As long as profits are high, it's not a problem. But when profits fall below the level of that fixed interest payment, the company starts bleeding cash, and its equity begins to erode. This is what turns a normal business cycle into an existential threat. For the investor, leverage fundamentally warps the risk-reward profile. Without leverage, if you invest $10,000 in a company, the absolute most you can lose is $10,000. Your downside is capped. With leverage, especially when an individual uses margin to buy stocks, the downside can be far greater. A margin call can force you to sell your positions at the worst possible moment, locking in losses and potentially leaving you with a negative net worth. Owing money to your broker, leverage offers the tantalizing prospect of amplified returns, but it does so by introducing the possibility of a total and complete wipeout. It is a trade that a prudent investor, focused on long-term capital preservation and risk management, should refuse to make. It's a bet you don't have to win. It's a bet you can't afford to lose. In 1972, Warren Buffett and his partner Charlie Munger made a decision that would forever alter the trajectory of their company, Berkshire Hathaway. They purchased a small, family-owned chocolate company based in California called See's Candies for $25 million. On the surface, it seemed like an odd acquisition for a company that had started as a textile mill. See's wasn't a high-growth, cutting-edge technology firm. It was a simple, even boring business. But Buffett and Munger didn't see a chocolate company. They saw a financial masterpiece. They saw a business with a fortress balance sheet. See's Candies required almost no debt. Its operations were funded entirely by the cash it generated. It had a beloved brand that gave it tremendous pricing power. They could raise the price of their chocolates every year without losing customers, meaning their profits were protected from inflation. Most importantly, the business was a gusher of free cash flow. After all expenses and even the minimal capital expenditures needed to maintain its stores and kitchens were paid, there was a huge pile of cash left over at the end of every year. This was the critical insight. The acquisition of See's wasn't just about buying a profitable candy business. It was about acquiring a cash engine. See's Candies had no need for that excess cash itself. The business couldn't grow much faster. So that cash could be sent back to Berkshire Hathaway's headquarters in Omaha. Buffett could then use this reliable, ever-growing stream of cash, the profits from selling chocolates, to buy other businesses, stocks, and bonds, all without having to borrow a single dollar. See's became the financial cornerstone upon which much of the Berkshire empire was built. It was the perfect embodiment of the fortress balance sheet principle, a simple, understandable business with zero debt, strong pricing power, and predictable cash flows. It wasn't the sexiest investment, but its financial structure was a thing of beauty. It was an asset that didn't just generate returns. It generated the fuel for all future returns, providing a level of financial freedom and optionality that a leveraged company could only dream of. The love for a business like See's Candies stems from a powerful psychological preference known as simplicity bias. Our brains are inherently lazy. We evolved to conserve mental energy. Given a choice between something simple and easy to understand and something complex and opaque, we will almost always gravitate towards the simple. In the world of finance, this bias can be a life-saving instinct. When a company's business model is so convoluted that you can't explain it to a reasonably intelligent person in 2 minutes, it's often a red flag. When its balance sheet is filled with complex off-balance sheet vehicles, exotic debt instruments, and indecipherable financial derivatives, It's an even bigger one. Complexity is often a place where risks hide. It can be used by management to obscure poor performance or to take on hidden leverage that isn't immediately obvious to a casual observer. The collapse of Enron in 2001 is the ultimate case study. The company was an impenetrable black box of special-purpose entities and fraudulent accounting, designed to hide billions of dollars in debt and losses. Only a handful of people on the planet truly understood its financial statements, and most of them were the architects of the fraud. Warren Buffett, by contrast, embraces simplicity. He has a famous rule: never invest in a business you cannot understand. This isn't because he lacks the intelligence to understand complex businesses. It's because he knows that complexity itself is a form of risk. A simple business like See's Candies or Coca-Cola has a clean, straightforward balance sheet. You can see the assets. You can see the liabilities. There are no dark corners where financial goblins can hide. By sticking to the simple and understandable, Buffett avoids the pain of complexity. He sidesteps the universe of companies where management might be smarter at financial engineering than he is at financial analysis. This isn't an admission of weakness. It's a profound recognition of the limits of one's own knowledge and a strategic decision to play only in games where the rules are clear and the risks are visible. A fortress balance sheet is almost always a simple balance sheet. So how can a retail investor without a team of analysts quickly and effectively identify a financial fortress? You use the 5-minute fortress check, a practical blueprint that requires nothing more than a company's publicly available financial statements. This isn't about deep financial modeling. It's a quick, powerful screen to separate the financially strong from the dangerously fragile. There are 4 steps. Step 1. Check the debt-to-equity ratio. This is the classic leverage gauge. On the balance sheet, find total liabilities and divide that number by total shareholder equity. A ratio below 0.5 is fantastic. It indicates a very conservative capital structure. A ratio above 1.0 suggests the company is relying more on creditors than on its owners to finance its assets, which warrants caution. Much higher, and you are looking at a highly leveraged entity. Step 2. Check the current ratio. This measures a company's ability to pay its short-term bills. Find current assets and divide by current liabilities. A number above 1.5 is healthy. It means the company has at least $1.50 in assets that can be converted to cash within a year to cover every $1 of liabilities that are due within that same year. A number below 1.0 is a major red flag, indicating potential liquidity problems. Step 3. Look at the retained earnings trend. This is one of Buffett's favorites. On the statement of shareholder equity, find the line item for retained earnings. This represents the cumulative profits that the company has reinvested back into the business over its entire history. You want to see this number growing consistently and substantially over the past 5 to 10 years. A steadily climbing retained earnings line is the signature of a durably profitable business that is creating real, organic value for its shareholders. It's the company's long-term savings account. Step 4. Check the interest coverage ratio. This measures the company's ability to make its interest payments. On the income statement, find the earnings before interest and taxes, or EBIT, and divide it by the interest expense. A ratio above 5x is considered strong. It means the company's operating profits are more than 5 times the amount it needs to pay its lenders. This provides a huge margin of safety. If a company passes these 4 simple tests, you can be reasonably confident that you are looking at a business with a true fortress balance sheet, a core requirement for any sound, long-term value investing strategy. The antithesis of this disciplined, numbers-based approach is the modern trend of narrative-driven investing, often propped up by misleading, custom-made financial metrics. The most notorious of these is adjusted EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization, with a few extra adjustments thrown in. In recent years, it has become common practice for unprofitable, high-growth companies, particularly in the tech sector and those backed by private equity, to encourage investors to ignore traditional, legally mandated GAAP accounting profits. Instead, they present a rosy picture using adjusted EBITDA, a metric where they conveniently add back all sorts of real cash costs, like stock-based compensation for their employees, restructuring charges, and other expenses they deem to be one-time events. This can make a company that is actually burning through huge amounts of cash appear to be profitable. The cautionary tale of WeWork is a masterclass in this deception. The company sold a grand narrative about elevating the world's consciousness and revolutionizing the nature of work. Their investor presentations were filled with soaring rhetoric and beautiful pictures. They also heavily promoted their own version of this adjusted metric, which they called community-adjusted EBITDA, a figure so laughably contrived that it excluded not just interest, taxes, depreciation, and amortization, but also basic building operating expenses like rent and utilities, the very core costs of their business. They were selling a story, a cult-like vision of the future, and investors, desperate for the next big thing, bought into it. They ignored the fact that the company's actual balance sheet was a disaster, buckling under billions of dollars in long-term lease obligations, which are a form of debt. When the narrative finally collapsed under the weight of financial reality, the company's valuation plummeted by over 90%, wiping out billions in investor capital. This is the danger of falling for a good story. A compelling narrative can be intoxicating, but it is no substitute for the cold, hard facts of a balance sheet. A fortress is built of brick and stone, not of dreams and community-adjusted EBITDA. The direct financial connection to building a portfolio of these fortress companies lies in the immense power of retained earnings. When you look at the equity section of a balance sheet, retained earnings represents the most honest and powerful source of a company's value. It is the sum of all the profits the business has ever made that were not paid out to shareholders as dividends. It is pure, organic, self-generated capital. A company with a huge and growing pile of retained earnings has an arsenal of options that a debt-laden company does not. It can fund its own growth, building new factories, investing in research and development, without having to ask permission from a bank or diluting its existing shareholders by issuing new stock. During a market downturn, it can aggressively buy back its own shares at depressed prices, a move that directly increases the ownership stake and future earnings per share for the remaining shareholders. It can pay a steady, reliable dividend, providing a direct cash return to its owners. And, most powerfully, as we saw with See's Candies, it can use that cash to make strategic acquisitions, buying other companies and adding their earnings power to its own. Retained earnings are the tangible proof of a management team's ability to successfully allocate capital over time. It is the financial engine that drives the compounding machine. By focusing your stock-picking tips on identifying companies that are masters of generating and reinvesting retained earnings, you are aligning yourself with businesses that are built for the long haul, creating a direct path towards building sustainable, generational wealth. The date is September 23, 2008. The world is in the grips of the most terrifying financial crisis since the Great Depression. Lehman Brothers had filed for bankruptcy just a week earlier, sending a shockwave of fear through the global markets. Credit markets were frozen solid. Banks, terrified of who might fail next, refused to lend to anyone, even to each other. The entire system was on the verge of collapse. While other financial institutions were either vaporizing, like Lehman, or running to the government for a bailout, like AIG, one company became the financial system's 911 call. That company was Berkshire Hathaway. In the heart of the panic, Warren Buffett received a call from Lloyd Blankfein, the CEO of Goldman Sachs. Goldman, one of the most prestigious investment banks in the world, was facing a crisis of confidence. Its stock was plummeting as investors feared it would be the next domino to fall. Blankfein needed a vote of confidence from the most trusted investor in the world, and he needed cash. Buffett, sitting on a mountain of cash within Berkshire's fortress balance sheet, was ready. But he would not act as a mere savior, he would act as a shrewd capital allocator. He agreed to invest $5 billion into Goldman Sachs, but he didn't just buy their common stock at the beaten-down market price. He dictated terms that were almost unimaginably favorable. He purchased $5 billion of preferred stock that paid him a guaranteed dividend of 10% per year. That's $500 million in annual income, guaranteed by one of the world's premier financial institutions. On top of that, he received warrants that gave him the right to buy $5 billion worth of Goldman's common stock at a fixed price for the next 5 years. Just a few weeks later, he struck a similar deal with General Electric, another blue-chip American icon on the ropes, injecting $3 billion on similarly lucrative terms. While the rest of the world was panicking and selling indiscriminately, Buffett was deploying his capital with precision and immense profitability. His fortress balance sheet had not just allowed him to survive the storm, it had transformed him into the storm's master. He wasn't playing defense. He was playing a brutal, decisive offense, an advantage made possible only by decades of disciplined aversion to debt. This was defensive investing transformed into a predator strike, a perfect example of how to beat the S&P 500 not just over the long run, but most decisively when it matters most. The psychological principle that enables this predatory advantage is a deep understanding of the fear and greed cycle, amplified by the power of herd mentality. Financial markets are driven by these two primal emotions. During a bull market, greed takes over. As prices rise, investors are gripped by FOMO. The herd mentality kicks in. Seeing everyone else making money creates a powerful social pressure to join in, often by buying assets at inflated prices without regard for underlying value. But when a crisis hits, the pendulum swings violently to the other extreme. Fear becomes all-encompassing. The herd, which was previously stampeding to buy, now stampedes to sell. Logic and rational analysis are abandoned. People sell not because the fundamental value of a company has changed, but simply because they are terrified that the price will be lower tomorrow. They sell good companies along with the bad in a desperate flight to the perceived safety of cash. Warren Buffett's entire philosophy is structured to exploit this predictable, irrational behavior. His fortress balance sheet is not just a financial construct, it is a psychological one. Because he is not leveraged, because he is not at risk of ruin, he is emotionally insulated from the panic. The fear that paralyzes the herd has no hold on him. This emotional stability allows him to adhere to his most famous maxim: be fearful when others are greedy, and greedy when others are fearful. The cash on his balance sheet is dry powder, waiting for the moment of maximum pessimism. When the herd is frantically selling, he is calmly and rationally buying world-class businesses at fire sale prices from those who are forced to sell. He is not smarter than everyone else. He is simply better positioned and more emotionally disciplined, a state of being that is a direct result of his financial preparedness. This professional-level strategy can be translated into an actionable mental model for any retail investor, the shopping list strategy. It's a proactive approach to portfolio management that turns market volatility from a source of anxiety into a source of opportunity. Step 1. This work is done during calm and even boring markets. You must identify a list of truly wonderful companies, businesses with durable competitive advantages, honest and able management, and, of course, fortress balance sheets that have passed your 5-minute fortress check. Step 2. For each company on this list, you must do the valuation work to determine your dream price. This is not the current market price. This is a price at which you believe the stock would be an absolute bargain, a price that offers you a significant margin of safety. This price should be calculated based on conservative estimates of future earnings or cash flows. Step 3. Create a physical or digital shopping list. Write down the names of these 5 to 10 great companies and your predetermined dream price next to each one. This act of writing it down is a crucial commitment device. Step 4. This is the most important part. You must build your own personal fortress. You must maintain a meaningful position in cash or short-term government bonds. This is your dry powder. It is not lazy money. It is opportunity money. It is the ammunition you will need for the hunt. Step 5. You wait. You wait for the market's inevitable moment of panic. It could be a recession, a geopolitical crisis, a pandemic. When it happens, and the market starts to plunge, you do not panic. You do not get glued to the news. You calmly pull out your shopping list. As the prices of your pre-vetted wonderful companies fall and hit your dream prices, you execute with confidence and conviction. You are not catching a falling knife. You are executing a well-thought-out plan, buying financial fortresses from a terrified market at prices you once only dreamed of. This single strategy is one of the most reliable ways for a retail investor to achieve superior long-term returns and truly beat the market. The path of the 99% is the complete opposite. For the average investor, who is often fully invested and may even be using leverage through a margin account, a market crash is a moment of pure terror and financial ruin. They are the prey, not the predator. Let's trace their journey. During the bull market, they were fully invested, chasing returns with little to no cash reserves. Some may have even borrowed money from their broker on margin to buy more stock, amplifying their exposure. When the crash begins, their portfolio value starts to plummet. The fear is visceral. But for those on margin, it's far worse. They receive the most dreaded notification an investor can get: a margin call. Their broker informs them that the value of their portfolio has fallen below the required minimum, and they must deposit more cash immediately, or the broker will begin liquidating their positions to cover the loan. They don't have the cash, so the broker begins to sell. And what do they sell? They sell whatever they can, often the highest quality, most liquid stocks in the portfolio. The investor is forced to sell their best companies at the absolute bottom of the market, locking in devastating losses. Even those not on margin are often forced to sell. Perhaps they lose their job in the ensuing recession and need the money to pay their mortgage. With no cash reserves, their stock portfolio is their only source of funds. They too are forced to sell at the worst possible time. They become the source of the bargains that the prepared investor, the one with the shopping list and the cash, is so calmly acquiring. They are the victims of the crisis, forced participants in a massive transfer of wealth from the unprepared to the prepared. The direct financial connection of this predatory strategy is the tangible and explosive growth in your portfolio's intrinsic value. When a company like Berkshire Hathaway uses its cash hoard to buy back its own stock at 50 cents on the dollar of its true worth, or when it acquires a great business from a distressed seller at a bargain price, that action is immediately accretive to the per-share value of Berkshire itself. The Goldman Sachs deal, for example, was a financial masterpiece. Over the next few years, Berkshire collected billions of dollars in guaranteed dividends. Then, as the markets recovered and Goldman's stock soared, they exercised their warrants, netting billions more in capital gains. The total profit on that single $5 billion investment was over $3 billion. But it's more than just the direct profit. By acting as the lender of last resort, Berkshire's reputation as the ultimate financial backstop was solidified, giving it access to future deals and opportunities that no other company could get. For the individual investor applying the shopping list strategy, the effect is the same. Buying a dollar's worth of a wonderful business for 50 cents is the surest way to build wealth. By systematically deploying cash during panics, you are dramatically lowering your portfolio's average cost basis and significantly increasing your future potential returns. This proactive, opportunistic use of a strong personal balance sheet is the most direct mechanism for an entrepreneur or retail investor to transform market chaos into a powerful engine for building lasting wealth and achieving financial freedom. Warren Buffett's philosophy of debt aversion is not confined to his corporate acquisitions. It is the guiding principle of his personal life. He is famously, almost comically, frugal. He has lived in the same modest house in Omaha, Nebraska, which he purchased in 1958 for $31,500 for over 6 decades. He famously drives himself to work every morning, often stopping at McDonald's for a cheap breakfast. He doesn't own a yacht, he doesn't have a collection of supercars, and his lifestyle is shockingly simple for a man whose net worth is in the hundreds of billions. This isn't just a quirky personality trait. It is the ultimate expression of his core belief system. It is the personal embodiment of the fortress balance sheet. By avoiding personal leverage and minimizing his fixed costs, he has built a life of immense freedom and optionality. He has no mortgage payment, no big car lease, no extravagant overhead that dictates his decisions. This personal financial discipline means he is never forced to sell his assets at an inopportune time to fund his lifestyle. His personal life is a reflection of his investment portfolio, durable, resilient, and immune to the pressures that force others into making poor decisions. Contrast this with the lives of many high-income professionals, doctors, lawyers, executives. Many of them earn huge salaries but are trapped on a treadmill of high expenses. They have the giant mortgage on the McMansion, the leases on 2 luxury cars, the country club membership, the private school tuition, and the crushing weight of student loan debt. Despite their impressive incomes, their personal balance sheets are a wreck. They are highly leveraged and financially fragile. They are just one job loss, one market downturn, away from a personal financial crisis. Buffett's simple life is a testament to the idea that financial freedom is not about how much you earn. It's about how much of that earning you can keep and put to work, unencumbered by the claims of others. The psychological force that drives so many intelligent people into this trap of high-income fragility is a combination of the hedonic treadmill and the powerful influence of social proof. The hedonic treadmill, also known as hedonic adaptation, is the observed tendency of humans to quickly return to a relatively stable level of happiness despite major positive or negative life events. When you get a big raise or a promotion, you feel a surge of happiness and satisfaction. But within a few months, that feeling fades. Your new, higher income becomes your new baseline. To get that same jolt of happiness again, you need another raise, a bigger house, a fancier car. You are on a treadmill, running faster and faster just to stay in the same psychological place. This is amplified by the principle of social proof. We are social creatures, and we constantly look to others for cues on how to behave. When we see our neighbors, colleagues, and friends buying bigger houses, driving newer cars, and taking more exotic vacations, we feel a powerful, often subconscious pressure to keep up. This keeping up with the Joneses phenomenon leads people to finance a lifestyle they cannot truly afford, using debt as the tool to bridge the gap between their income and their aspirations. Warren Buffett has made a conscious, lifelong decision to step off this treadmill. He is immune to social proof. He does not care what others think of his house, his car, or his breakfast choices. By detaching his self-worth from the external markers of wealth, he has liberated himself from the psychological pressures that lead so many into the bondage of debt, allowing him to focus on the true scorecard, the compounding of his capital. This powerful corporate and personal philosophy can be directly applied to your own life through the Personal Fortress Audit. This is a practical blueprint for building financial resilience and achieving true financial freedom. Step 1. Calculate your survival number. This is the absolute bedrock of your plan. Go through your bank and credit card statements and add up all of your truly non-negotiable monthly expenses. Your rent or mortgage, your utilities, your groceries, transportation costs, and the minimum payments on any existing debts. This bare bones number is the monthly cost of your survival. Step 2. Build your moat. This is your emergency fund. Your first financial goal should be to save 3 to 6 times your monthly survival number in a separate, liquid, high-yield savings account. This is your personal cash on hand. This moat protects you. If you lose your job or face an unexpected medical bill, you can draw from this fund without having to sell your long-term investments at a bad time or take on high-interest credit card debt. It is the single most important buffer between you and financial disaster. Step 3. Deleverage your life. Systematically attack and destroy any high-interest consumer debt. List all of your debts, credit cards, personal loans, auto loans, from the highest interest rate to the lowest. This is the debt avalanche method. Throw every spare dollar at the debt with the highest interest rate, while making minimum payments on the others. Once it's paid off, roll that entire payment amount onto the next highest rate debt. Every dollar of high-interest debt you pay off is a guaranteed, risk-free return on your money equal to the interest rate. It is one of the best investments you can possibly make. Step 4. Live well below your means. The gap between what you earn and what you spend is your personal retained earnings. This is your profit margin. Your goal should be to make this gap as wide as humanly possible. This surplus is not for upgrading your lifestyle. It is the capital that you will use to acquire income-producing assets, stocks in fortress companies, real estate, your own business. This is the engine of your wealth creation. The antithesis to this fortress-building approach is what can be called the income statement life. This is the path the vast majority of people follow. They are focused exclusively on their income, their salary, their top line. They work hard to get a raise, and the moment they do, their spending immediately inflates to meet or even exceed that new income. This is Parkinson's law applied to personal finance. Expenses rise to meet income. They might have an impressive income statement, with a large salary coming in at the top, but their personal balance sheet is a catastrophe. They have minimal assets, perhaps a small retirement account balance, and a mountain of liabilities in the form of a mortgage, car loans, student loans, and credit card debt. Their net worth is either stagnant, small, or even negative. They are living paycheck to paycheck, regardless of the size of that paycheck. They are acutely fragile, trapped in a golden cage. They have no optionality. They cannot afford to take a lower-paying job they might love. They cannot afford to start a business. They are one unexpected event, a job loss, a health crisis, a major car repair, away from complete financial ruin. They have built a life that looks successful from the outside, but is internally hollow and terrifyingly precarious. They have prioritized the appearance of wealth over the substance of building wealth. The direct financial connection for you, the viewer, is your own personal net worth statement. This is the ultimate scorecard of your financial health. Income is important, but it is fleeting. You can lose your job tomorrow. Net worth, on the other hand, is the true measure of your financial resilience and progress. It is a simple calculation: the value of everything you own, your assets, minus the value of everything you owe, your liabilities. The entire philosophy we have discussed today is about systematically increasing this single number. By applying the personal fortress audit, building a cash moat, aggressively paying down your liabilities, and using your personal retained earnings to acquire income-producing assets like stocks in companies with fortress balance sheets, you are directly manipulating this equation in your favor. You are decreasing the liability side of your personal balance sheet while simultaneously increasing the asset side. This is not a get-rich-quick scheme. It is the application of a time-tested, rational, and durable corporate strategy to your personal financial life. It is the most reliable and proven path to building lasting wealth, achieving true financial independence, and gaining the ultimate prize, the freedom to live life on your own terms. You have just been given the blueprint for the single most powerful principle of capital preservation in the investing world. You now understand that debt is not just a financial tool but a source of profound fragility. You have the mental model to identify fortress balance sheets and the strategic plan to use market chaos as your greatest opportunity. This knowledge alone separates you from the 99% of market participants who are unknowingly gambling with their futures. You have built the foundation of the fortress. But a fortress is only as strong as the territory it is built to protect. Understanding how to build unshakable financial walls is the first step, but it is useless without knowing which businesses are the priceless kingdoms worthy of such protection. Buffett's aversion to debt is the defensive pillar of his temple, the one that guarantees survival. But it is the offensive pillars, the ones that support his uncanny ability to identify truly wonderful businesses with unbreachable competitive advantages, that create legendary returns. This defensive principle you've mastered is what allows him to stay in the game. His principles of identifying economic moats are what allow him to win it. The video that YouTube is showing you on the screen right now is the next piece of that map. It is the critical link that connects defensive investing to offensive growth. It moves beyond the balance sheet to deconstruct the income statement and the cash flow statement through Buffett's eyes, showing you the specific financial signatures of a company with a near-monopolistic grip on its industry. It translates the abstract concept of a competitive moat into hard, quantifiable metrics you can find in any financial report. You have taken the first, most crucial step from being a speculator, tossed about by the whims of the market, to becoming a true investor who thinks like a business owner. The question now is, are you ready to continue the journey to becoming a master capital allocator? The path from simply preserving your capital to compounding it at an extraordinary rate lies in connecting these powerful, interconnected mental models. The next piece of the puzzle is right there. The choice to click is not about watching another video, it is a commitment to continue your ascent, complete your arsenal,